Here to discuss, BNP Paribas Asset Management Chief Market Strategist Daniel Morris. Daniel, thanks for being with us today. Sure. So what do you do in this kind of environment then? If you think that we might at least be close to lows, do you pick up some of these names and wait for what PTD calls the massive rally eventually?
Yeah, you wish you could just fast forward to the rally bit and not have to go through what might occur between now and then. Certainly that'll happen. I mean, if you think of how markets react at the end of recessions, those are the greatest opportunities, March 2009. I fear we're probably not quite there yet. I mean, if you think about particularly for tech stocks and for growth stocks, we've had one shoe drop, if you will, over the course of the year, which has been the increase in policy rates and real rates and discount rates. And that's clearly been very challenging for valuations for growth stocks. But that second shoe, which is the decline in growth, earnings growth, economic growth, that really hasn't happened yet. I mean, if we look at the U.S. economy, what's the message from the non-farm payrolls data is that growth is still good. And what we hear from companies is that they're struggling to meet the demand that's out there. So we're still waiting for the impact of the interest rate hikes that the Fed is putting through to slow down growth. And we really have to go through that process first.
Yeah, important distinction between what's going on in the markets and that real economic data, Daniel. Our first guest this hour, though, Jeff Lewis, he said that investors should be really cautious of some of those unprofitable tech names, even if you see a little bounce, that a lot of them are never going to recover. What do you think?
Well, we had a rally a month or so ago. I think we're likely to see potentially a rally going through the third quarter earnings season because, even if we're cautious about the outlook, I would anticipate we're going to have earnings surprises. But you're right. If you're still going into an environment where growth is going to be slowing and companies that haven't been profitable up to this point probably are not going to suddenly become profitable if you're in a recession, and whether they make it through certainly is a good question to be asking.
But Daniel, are you on the hunt for some of these growth names? And if you are in this environment, is it because of something that you think is just going to happen in the market over the next 6 months, or because you think that these are valuable to hold over a longer term of years, whatever the macro bears out heading into 23?
No, absolutely. And, it always comes down to what your investment time horizon is. And really, if we look at what's happened to valuations for a lot of growth stocks, we're always looking for those stories that we think have legs as something we can believe in over the long term. And if this is an opportunity to get those stocks, make those investments at an attractive price now, I mean, yes, it may go down more, but we do believe that ultimately they're going to recover. So we do see it as an opportunity. And I think the other thing to keep in mind, as we get closer to that recession, on one hand, of course, we do worry about what does that mean for corporate profits, but it's at that time exactly that growth is is most valued by investors, and they're going to be turning even more to growth stocks at that time. And that's going to mitigate some of the downside you would expect on their earnings front, just because demand, if anything, is going to pick up for the sector.
Daniel, I see that you're overweight China, and that's partly a call on tech. Explain that.
Well, certainly China, right now is having a lot of problems. We're very aware of the restrictions around COVID. Property market is dragging on demand. But the benefit, if you will, of that is if you look at relative valuations of Chinese technology shares versus the rest of the world, or essentially U.S., they're at a really steep discount. And we do believe in the medium-term story, for the technology sector in China. So because of the very negative sentiment, which is really quite exacerbated towards China right now, even more than in the U.S., we do see a lot of opportunities there. So selectively investing, in particular names and in our multi-asset portfolios have an allocation to China, and particularly an index that has a bigger weight to the technology sector.